everyone, it's Keri TV, and we're back today from the Knowledge Office with more information about the housing market, foreclosures, the market crash, and all the reasons why this market is very different. So if you haven't seen this channel before, make sure you subscribe, like, throw me a comment. Every Tuesday we come out with new information about the market. We hit you hard with stats that are relevant and fresh, and we keep you updated. So stay tuned for today's episode. So we're heading into my favorite time of year, summertime. I'm such a summer baby, Cali baby, and the market is even hotter than the weather. It's actually over scorched. Inventory is so extremely tight. It is very competitive, and there's all these looming talks of foreclosures. And the crazy thing is, this is like this all over the country. I work with agents all over the country, Canada and Mexico as well, and every single agent I'm speaking with is suffering the same issue in their markets. Things are extra competitive, there is no inventory, and these buyers are doing everything they can to get into homes. 10 offers, 20 offers, 30 offers. But here's the thing, with all this going on, I specifically want to talk about the discussions around foreclosures, the looming foreclosures, the tsunami of foreclosures, the forbearance, and how this impacts the current market and what is really going to happen next. So what is going to happen when these 2 million people in forbearance all of a sudden can't get any more extensions and they foreclose? What is going to happen? Is it 2008? All over again? Well, the reality is we are so conditioned to what happened in the last crash, 2006 through 8, that we are expecting to repeat that same crash. So people think what happened then is going to happen now. To let you know, I was also in that market because I've been in residential real estate sales since 2003. So I know exactly what happened then, and it's exactly what's happening now. So just so you know, everything that I explain on Keri TV is strictly fact-based. I do not come in here with my opinions. I'll give you examples of what's going on in the real estate world, but all the research I do, all the articles I read, give you that information so you can make informed decisions about the market. But what I specifically deliver here is market facts. And that's why today I'm going to give you 4 reasons why the foreclosure market is so wildly different than the last housing crash in 2006, 7, and 8. Reason number 1, almost 50% of homeowners who have left forbearance have already caught up on their payments. The banks did not have guidelines when they allowed people to stop paying, so many people decided, hey, if I can stop paying, why not try it? If I don't have to make a mortgage payment, let's not make it. But once consumers and homeowners found out that they actually had to pay the money back, that it was going to impact their credit, that it was going to roll onto the end of the loan, they decided, okay, let's start paying our mortgage. And also it was a time, remember, where we all didn't really know what was going to happen. So there was a month or two where people maybe took their foot off the brake for a minute, but 50% of these people have already caught up on their mortgage payments. According to the Mortgage Brokers Association, MBA, 48.9% of homeowners who have already left the program were current on their mortgage payments when they exited. So of these people that caught up, half of them were already current. 26.6% made their monthly payments during the forbearance period, 14.7% brought their past due payments current, and 7.6% paid off their loans in full. That doesn't mean that the over 2 million still left on the plan will exit exactly the same way. We're not saying that at all. It does, however, give us a little insight into the possibilities though. Basically saying that when this forbearance came out, so many homeowners opted into it just because they didn't know what was going to happen. But when it came out that it was going to impact their credit and they find out that they can't possibly buy their next home in 6 months, people quickly jumped back in. So the numbers were vastly skewed on this foreclosure forbearance plan that was coming out. Reason number 2, these banks, they don't want their houses back. They don't want to be landlords. They remembered what happened last time, and they're doing everything they can to make sure that they do not become landlords again. So they're making sure that homeowners can stay in their homes. The last time when these banks were representing or repossessing homes, it was a nightmare. You had people staying in the homes, you had squatters coming in. If you worked in the industry, which I was in the REO industry at the time, you'd have to go in with pepper spray, mace, take backup. Sometimes you'd have to call the cops to go in just to collect keys for cash. folks don't want to do this. They don't want to get into this industry where they're having to go through this. I mean, the amount of work the REO industry went through, it was not on their radar of what they wanted to do. So 2021, there's some new plans going into place. In 2008, the FHFA offered 208,000 homeowners the Home Retention Act, which offered some kind of help when it came to this forbearance, such as temporary forbearances, they had repayment plans, they had loan modifications, partial loan deferrals. These helped to link homeowners stay in their homes. So back then, 208,000 people were offered this plan. This time, the FHFA has offered that same protection to over 1 million homeowners. That's a big difference for people that are going to be helped on this plan. Today, almost all lending institutions are working with their borrowers. The report from MBA reveals that of those homeowners who have left forbearance, these are the stats. 35.5% have worked out a repayment plan with their lender. 26.5% were granted a loan deferral where a borrower does not have to pay the lender interest or principal on a loan for an agreed upon period of time. And 9% were given a loan modification. It's pretty great stats, pretty good options. The third point is the government is determined not to let individuals lose their homes. They're actually talking about penalties to mortgage companies who are not offering any type of help or deferment on any of these programs similar to the Home Retention Act. That's pretty cool. Here's a quote from Bloomberg. Mortgage companies could face penalties if they don't take steps to prevent a deluge of foreclosures that threatens to hit the housing market later this year, a U.S. regulator said. The Consumer Financial Protection Bureau, CFPB, warning is tied to forbearance relief that's allowed millions of borrowers to delay their mortgage payments due to the pandemic. Mortgage servicers could start reaching out to the affected homeowners now to advise them on the ways they can modify their loans. So this is a very different approach than 2008, as you can see, with preventative measures and even possible penalizations threatened to be in place. Clearly, they are doing something different. All right, this one is huge. If all else fails, homeowners will just simply sell their homes before foreclosure even happens. Homeowners have record levels of equity today. It is insane. According to the latest CoreLogic home equity report, the average equity of a mortgaged home is currently $204,000. In addition, 38% of homes do not have a mortgage at all. Only 10% of homeowners in the United States have less than 10% of equity in their home. So in theory, if they can't figure out a loan modification, a loan deferral, a loan repayment, temporary forbearance, all the options stated above, they're simply just going to sell their homes. So this foreclosure market is so entirely different from the last one, but it makes sense the same way that our parents and our grandparents are all a little traumatized from the Great Depression and how they were raised and how differently they act towards money versus the millennial market in this new generation. This is how we are traumatized by the last market crash. So we feel like we're going to have 2006, 2008 all over again, the same way that the baby boomers and their parents think about the Great Depression times. So in closing, these are the 4 main points about the foreclosure market. I get asked this a lot, so I wanted to make a quick video to talk about these points because it is very important to stay updated on the market. And I cannot thank KCM, Keeping Current Matters, enough for all their amazing information that they aggregate all into one place, like from the MBA, the FHA, CoreLogic, all these great resources. So thank you for watching today. Stay tuned for more information next week, per usual, here on Keri TV. Cheers, guys.